Hello and welcome. I'm your host, Gregory Saxton. I'm an associate professor of accounting at the Schulich School of Business and a member of Schulich Centre in Digital Financial Information, which is generously supported by CPA Ontario. We're excited to bring you today another webinar from Dr. Wendy Tietz from Kent State University in Kent, Ohio, and Dr. Tracy Miller, who is the program chair for the BS in Accounting at Franklin University. They will be speaking on how to interpret and use the statistics in Excel's Data Analysis Toolpak. Thank you for joining us today, and welcome, Wendy and Tracy. Take it away.
Thank you so much. Welcome, everyone. We are going to get started here. So I'm going to get us going here. We are going to be talking about how to use the Data Analysis Toolpak in Excel, and we've got some logistics to go over first, and that's what I'm going to do. So next slide here. So first of all, addressing, if you use a Mac, the steps are same or similar. When there is a difference, we will mention the Mac instructions after the Windows instructions. So if you use a Mac, know that you might need to wait till the end of something to get there. So next. Okay, now you can try everything that we're talking about today on your own. In the chat room, if I can do this as I'm talking, I am going to first of all put a link to a PDF of our slides. Now the PDF that I'm giving you of all of our slides is actually more than the slides you'll see today. Today we are not doing hands-on. We are going to tell you what you can do with it, what it means, but then that's really meaningless if you don't get any instructions for how to do it. So what we've done is the PDF that I have put in the link to the PDF that I've put in the chat room gives you all the slides, including the ones that we are not covering. And now I'm going to tell you how to get to that. So those PDFs of the slides are for you to use later on on your own. We only have an hour, so we're going to focus on what's in there and how you can use it. But in terms of the actual step-by-step instructions, those will be in that PDF. Also, on your own, if you want to try everything that we're talking about, we also have an Excel file that accompanies what we're doing. And I put the link for the Excel exercise in the chat as well. And that is the Excel file that if you download that goes along with our PDF of the slides. And then finally, the third file that I'm putting in the chat room is the solutions for that. So if you want to try it on your own, go the how-to. We've also provided a solution file for you. So that's to start off the logistics. And within another couple of minutes, I'll probably put those same links in the chat for anyone who's joining us late. But there are 3 files, a PDF of the slides of everything we're doing today, plus more. And then the Excel file, if you want to try it on your own, and the solution file. Again, we are not doing hands-on today, so you don't need to open the Excel file, but that's for you later on, so you know you can apply what we were talking about. Okay, next one. So when you do open those Excel files, they are all coded. There's worksheets in that Excel file, and there's worksheet 1, 2, 3, I think all the way up to 9. There's also a blank 1, 0, 0. And those correspond to what we're talking about today. So we have worksheet 1, which is an introduction to descriptive statistics, and that's the hands-on activity that goes along with that. Next slide. Okay, and then we have the extra slides inserted as we go, but if you're following the PDF, when we go to a new topic, you'll see a new worksheet divider slide like I've got on the screen here. Here's worksheet 1, 2, 3. That's a signal that we've switched to a new topic. So the presentation today is organized by those different worksheet divider slides, and we are not covering all the how-to steps, just kind of the introduction to each one of those. Okay, next slide. Okay, so what is the Data Analysis Toolpak? It's basically an add-on to Excel that gives you a lot of capability to analyze data, all prepackaged for you. Many of the things that we do today, you can do by using formulas, but formulas are not nearly as easy to use, and it's easy to forget what a certain piece of a formula means. So the Toolpak allows you to do it in a more user-friendly manner. Next slide. Okay, so worksheet 00, we're going to go through these pretty quickly. So this is I just want to show you what you need to do to get the Data Analysis Toolpak. It is not by default on in Excel, so you have to add it. So the first step when you add it is to click on the Data tab and then the Data Analysis that's when you add it. Again, if you're a Mac user, this won't work. We'll get to you in just a minute. Next slide. Then you click on File, Next, click Options, and this is how you're adding it. So next, click Add-ins, click Go, and select the Analysis Toolpak. And click OK. So Mac users, that File tab does not exist in Excel for Mac. So in the PowerPoints, we've included the instructions for how to add the Data Analysis Toolpak if you're using Excel for Mac. Next slide. So when you're using the Data Analysis Toolpak, when you open it up, when you do have it on your system, you're presented with a whole bunch of different tools. And we're going to be covering several of these today. Next slide. This is kind of a list of all the basic types of data analysis tools within the Toolpak. And on the next slide, these are the ones that we are going to be focusing on today. We're going to be talking about descriptive statistics, histogram, sampling, both random and periodic, and correlation or regression. Now, how this is going to work today is I've done this introduction. In just a minute, I'm going to turn it over to Tracy, and I'm going to go off camera, but I'm going to be monitoring the chat. So if you have any questions as we go, I will be answering those questions, or Tracy might answer them as well. So at this point, so don't be shy, ask questions in the chat. And at this point, I'm going to turn it over to Tracy.
Thank you. Thanks so much, Wendy. Yeah, we're excited to talk to you today about the Data Analysis Toolpak. One of the things that I think practitioners don't often realize is that we have this feature available in Excel. Now, we know that as accounting practitioners, you most likely use Excel, if not every day, probably most days that you are working, you're utilizing a tool such as Excel. The Data Analysis Toolpak, to go back to the slide that shows all the tools that are available, has a lot of data analysis related to statistical analysis, such as ANOVA, correlation, covariance, regression, t-test, z-test, Fourier analysis. So if you ever took a statistical class in the university setting, some of those words may be coming back to you. And those are available in the Data Analysis Toolpak. But as Wendy mentioned, we're going to focus really on the areas that are going to be beneficial to you as a practitioner. Now, again, one of the most important things to remember, as Wendy shared at the beginning of this session, is the Data Analysis Toolpak is not automatically loaded into your Excel software. So if you are practicing this at home and you go to look for the Data Analysis Toolpak, it is not going to most likely be there, and you will have to go through that adding process that Wendy shared. Now, why do we want to use the Data Analysis Toolpak compared to just utilizing the formulas in Excel? One of the reasons why is the Data Analysis Toolpak allows us to do analysis in a much quicker way. So I'm going to show you in just a minute one of the features, which is the descriptive statistics feature. And in the descriptive statistics feature, we can simply by the click of a button get all of the descriptive statistics related to a data set without ever running any of the formulas. So we automatically get statistical information such as average, max, minimum, those types of things. We don't have to know the formulas, although many of us do know those formulas. But as you know, when you're doing the formulas, you can often introduce errors into the data analysis side. And so by utilizing the tools that are in the Data Analysis Toolpak, you're going to be able to do those features that we can do with formulas much quicker and in a much more simplistic manner. The Data Analysis Toolpak also allows us to build a histogram, and a histogram is a visual representation of data. And we'll show you in a moment how that histogram can be used for things such as analysis when we're looking into data sets to try to figure out if our data sets are the way we believe they should be. So, do they look like the data that we think it should be? And also to investigate, to identify different areas that we need to investigate further. Now, some of you may be working in the audit space. There is a sampling feature that's available in the Data Analysis Toolpak. It's a very nice sampling feature that will just pull a random sample or a periodic sample. I'm going to show you how to do that very easily using the Data Analysis Toolpak. And then we're going to finish up with showing you how to do correlation and regression. We will also hopefully get to a brief bonus feature that we've tied in, which will utilize a tool that builds off of the histogram with Binford's analysis. So let's get started. We're going to start off by talking about the descriptive statistics. Now, descriptive statistics is one of the features that's available in the Data Analysis Toolpak. So after you load the Data Analysis Toolpak into Excel, you're going to always go to the Data tab to find the Data Analysis Toolpak. You'll click on the Data Analysis link, and then when you do that, it will open up this window for you, which has all of the different analysis tools. Now, this shows you in worksheet 2 of the example that you're going to get. It shows you a sample of what the descriptive statistics look like. Now, for some of you, it may have been quite a while since you have taken a statistics class or maybe even a math class. And I think it's beneficial for us to go over all of these different statistics and talk about how they can benefit us as a accountant. So the first area that we're going to look at is we're going to look at measures of central tendency. Now, going back to your math class, thinking about what does measures of central tendency mean? Well, measures of central tendency just represents how a set of numbers is centered around a particular point on a line scale. So where do the numbers bunch up together? Do we have a lot of numbers around a central area, or is our data widely spread out? And we can determine what our data looks like by using measures of central tendency. Those measures of central tendency are going to be mean, median, and also mode. Now let's take a look at the first tool, which is going to be mean. The very top number when you run the descriptive statistics is going to be the mean. Now, the mean is an average of a set of numbers, or it's the central value of a set of numbers. Now, average, as you know, is a common thing that we use in accounting. We often look at the average expenses that are spent in a particular area for a business. When we do estimates, sometimes we'll do an average amount when we're calculating a budget number. And so the mean or the average set of a numbers is a very useful feature for us to rely on. Now, we know if you're familiar with Excel, you know that you can calculate this simply by doing the calculation by using a formula. But again, as I mentioned, this provides us with all these statistics in one place, allowing us to be able to get all this data very quickly. Now, I might say and mention that I often tell my students that average is not always a great representative of our data, especially if our data is skewed one way to or the other way. So, or if we have a large outlier as an example. So let's say that we're looking at expenses that are spent for computer equipment. And we're trying to find out the average amount of expenses that are spent on computer equipment in the last year. If the majority of our expenses are all around in America, the $500 mark, then we would see that that would be the average. But if we have one expense that's way outside of the average, then that's going to skew my data in a different direction. And my average will no longer really be representative of what I really spent for most of my expenses. And that is why we often look when we're looking at the description of our data, we often look at the median. And the median is the middle of a sorted list of numbers. And so here you can see in the example that I give you here, we have 7 numbers on a number line, 10 through 26. And the fourth number represents the middle number. And in that example, 15 would be the median of that sorted list of numbers. Now, again, when your data is skewed, the median is going to most often or more likely be a better measure of what is the middle of your data set. And so I think it's very helpful when you're looking at data to look not only at the average, the mean, but to also look at the median and then to think about which is the better number here. You can tell in our data here, our average is $1,017. Our median is only $450. That's a wide swing between the average and the median. That tells me that my data set is extremely skewed. If our median and our mean are closer to each other, then, or even exactly the same, then that lets me know that my data is less skewed. Now let's look at the other feature of central tendency, and that is the mode. Now, the mode is the number that is occurring most frequently in a set of numbers. Excuse me. So, in the example that we're looking at here on the line chart, we see that we have more sixes than any other number. Now, in our statistical data that we're looking at on the left-hand side, this is check data. And so I can see for some reason, I have most of my, the most frequent check that I wrote was for $77. Now, maybe that makes sense. Maybe I have a weekly expense every week that is for $77, and it makes complete sense. But maybe that doesn't make sense. And so the mode can be used to help us identify areas that we need to investigate further. Now, we can also look at some other features that are in this descriptive statistics area, and that is sum and count. Sum clearly is just a summation of all of the values. So in the data set that we're using, this is checkbook data for a city in Ohio. The total amount of checks written was $868,934. They also wrote a total of 854 checks. Now, how can this be useful if we're analyzing the data? Well, when I talk to my students about data analysis, before we ever begin the analysis piece of it, we have to ensure that our data is complete. And one of the ways that we can do that is by simply just running a count of our data. I know that I had 854 checks that were written, and did all of my data, was it all included in the analysis that was provided? I also want to ensure the integrity of my data. So if I am looking at a data set that can tie to either the financial statements or the ledger, the sum feature will allow me to be able to tie out the data to that data point. So that if I'm looking at total cash expenses, I should be able to take my descriptive statistics for sum, and I should be able to tie that number out to, for example, the statement of cash flows. Now, we also have some other features that are available in the descriptive statistics area. Now, we looked at measures of central tendency, which is where data lies on a data line, but we also can learn about measures of variation from descriptive statistics. In measures of variation, we see the range or the variation of the numbers about around a center value. So we see how far is our data spread out in what we're looking at. So we can look at the range, we can look at minimum, and we can also look at maximum. Now let's start by looking at range. Range is simply the difference between the lowest number, the minimum, and the highest number, the maximum. Now, how can range help us? Well, this is checkbook data, and it's interesting. When I first pulled this analysis, I was looking at the measure of variation, and I noticed that we had a minimum number on that was negative on our checkbook data. Clearly, that is something that we can investigate further. It's not likely that we would have written a negative number in a check register. And so these types of descriptive statistics can help us just get an understanding of what our data looks like and an idea of where we can go further. When we look at skewness tells us how far the numbers are scattered about the center value of a set of numbers. So is our data left skewed, or do we have a normal distribution, or is our data right skewed? Now let's talk a little bit more about what that means when we're thinking about data. So here on the screen right here, we see a normal distribution of data. In a normal distribution of data, the data is distributed equally or symmetrically around a center value. And that center value is the mean, the median, and the mode. And you'll notice that when our data is normally distributed, that all three of those numbers are equal to each other. Now, just normal distribution is very helpful, especially in areas when you're trying to figure out what does the normal set of data look like. Because when I have normal distribution, I can say that the majority of my data lies in this percentage, and it's very symmetrical. 50% above the mean, median, and mode, and 50% below the mean, median, and mode. But unfortunately, or maybe fortunately, We as accountants, we don't work typically in data that is normally distributed. Instead, most of our data is skewed in some direction or another direction. So this is a positively skewed data set. Now, positively skewed data is data that is skewed to the right, which means that my mean is going to be larger than my median, which is going to be larger than my mode. Now, when I teach to my students, they have a hard time remembering, is my data positively skewed or is my data negatively skewed? And the way that I always remember it is I talk to them about the skiing example. So I love to ski, but I'm not all that great of a skier. I'm kind of an average skier. I like to stick to the blues. I don't like to do the steep hills. And so I tell my students to think about me sitting at the very top of that data distribution there at the very top and asking themselves, which way would Dr. Miller choose to go down? Well, I would go down the easy way as opposed to the steep way. And so the easy way, if I'm standing at the top of the mountain, is to the right. And so that means that my data is right skewed. It's longer on the right side than it is on the left side. Now, the alternative of that is negatively skewed data or data that's skewed to the left. Now, when we have negatively skewed data, our mean is smaller than our median, which is smaller than our mode. Again, thinking about which way this is skewed. If I'm sitting at the or standing at the top of the ski mountain, I'm going to go down the left side because that's the easier way to get down the hill. And that means that my data is going to be left skewed. Now, I wonder, do you think I already told you that financial data was not normally distributed. But do you have a sense of whether you think financial data tends to be more right skewed or more left skewed? If you want to just pop it in the chat box, we'll just see what you guys think about this. Do you think that financial data tends to be more left skewed or more right skewed? So I'm just going to look in the chat box and let's see what we have. So we've got a lot of different things here. Okay, so let's take a look at this. So most of you have gotten this correct. Our financial data tends to be more positively skewed or right skewed. The reason why financial data on average tends to be more positively skewed or right skewed is because in a general data set for financial data, we tend to have a lot more frequency of small numbers compared to a lot more large numbers, high numbers. So we tend to have a lot more frequency of our smaller numbers than we tend to have of our larger numbers. So what we see here is an example of a histogram and what it looks like when we do a data visualization of what our data looks like when we compare it to the mean, the median, and the mode. And you can see here that if I'm standing at the top, my data is certainly skewing down to the right. We also know that when looking at our descriptive statistics, that in the descriptive statistics, we see the skewness, and that skewness is positive. If it was negatively skewed or left skewed, we would see a negative number in the data statistics area in that descriptive statistics. So there's a lot of information that the descriptive statistics can give us. Now, it can also give us standard deviation. Now, standard deviation, in my opinion, is really only helpful when we're looking at a normalized set of data. Standard deviation tells me how spread out the numbers are. And when we're looking at this example here, we can see that if we had a normal distribution, which we don't tend to ever have in financial or very rarely have in financial information, we would be able to say a standard deviation tells us that approximately 68% of our data is within one standard deviation of the mean. And then if I go out to two standard deviations, approximately 95% of my data is within two standard deviations of the mean. But again, standard deviation is really only useful to evaluate data that is symmetric. So if I go back to our financial data visualization, I can clearly see that 68% of my data is not centered around the mean. And that's because my financial data is skewed to the right. So I can't use those percentages. So, descriptive statistics can be really very helpful in just giving us an idea of what the data looks like. But a lot of times, when we are going into thinking about what do we want to investigate further or what does our data look like, in my mind, it's so helpful to do an actual visualization so that I can really see what the data looks like. So, one of the easy ways to do this is to simply utilize the tool that's available in Excel, which is to do a histogram chart. Now, what is a histogram chart? Well, a histogram chart is simply a visualization that shows you the frequency of your data or the count of the data in each discrete bin of data. So let's take a look at this histogram chart that we have here. Notice that this is we're using check transaction data and we're looking for the frequency of the dollar amounts of check transactions. So when we look at this data, we can see that the majority of my checks, 453 checks, have been between an amount of $4.50 and $484.50. Now, how might this be helpful? Well, if I'm looking at thinking about, where do I maybe want to start looking at checks and verifying the dollar amounts, I would probably want to pull a larger sample from this first bin of 450 to 484 because I have more frequency of data in that area. But this histogram can also be really helpful because it can also tell you where your smallest data sets exist. And in our situation, the smallest data sets exists, of course, in most cases in financial data, in the highest ranges, in 5,800 to 6,200 in our sample. And we see that there's only 5 checks that have been written in that area. So, histogram charts are very useful in being able to show you what your data looks like and to give you an idea of where you could potentially investigate further. Now, histogram charts are available from the Data Analysis Toolpak. They are also available in the chart area of regular Excel without adding in the Data Analysis Toolpak. And if you are a Mac user, then you have to, of course, go to a special area of the Mac Excel, which is the statistical icon in chart types, and that will allow you to find the histogram. Now, I want to point out, as Wendy mentioned, all of these features that we're showing you here today are going to be available for you to practice and recreate the charts that we have available for the charts that we've created here. So as Wendy mentioned, and I know she's put in the chat box for you, there are, you have an Excel file that contains just the data. You've got a PDF document that you can walk through each of the different steps that we're doing, and you're going to get step-by-step guidance on how to actually recreate all of these data analysis tools that we're utilizing here. Now, we have looked at a histogram chart, and I want to show you a variation of a histogram chart that I think is very useful. And that variation of a histogram chart is a data visualization tool that's called a Pareto chart. Now, a Pareto chart takes a histogram and then shows the cumulative percentage of that frequency of the data. So we see that we have simply taken the frequency, the histogram, and then we've added in this orange line. So what does that orange line tell me? Well, that orange line tells me my percentages. So I know it's small on my screen. I'm not sure how it looks on your screen, but if you could look at this carefully, you would see that this orange line starts at the 50% area. So that tells me that more than 50% of my transactions fall in that largest bin. Now, Pareto's are cumulative percentages, so that's why we see the line increasing as we go along to 100%. Now, Pareto's are really useful because they show you kind of where the breaking point of your data is. So if we go over to, for example, the third bin, we see that more than 75% of our transactions fall between $4.50 and $1,400 approximately. So 75% of my transactions fall in those three bin categories. So Pareto chart is useful because not only does it show you the largest frequency, but it also shows you the percentage of where your data falls. Now again, Mac users, you're going to have a special way that you're going to get to the Pareto chart. Again, that Pareto chart is going to be available for you, but it's only going to be available utilizing that statistical icon. Okay, so now let's take a look at another feature that we have available in the Data Analysis Toolpak, and that additional feature is the random sampling feature. We have two sampling options that are available in the Data Analysis Toolpak. The first option that's available is going to be the random sample. So again, utilizing the check data that we're going to have an Excel spreadsheet. It's going to have tons of checks listed on that Excel spreadsheet, and we want to just pull a random sample of those checks. Now, in a random sample, as compared to a periodic sample, which we will look at in just a moment, in a random sample, every value has an equal probability of being chosen. So it's a completely random sample. So again, to get to that random sample feature, we're going to open up the Data Analysis Toolpak in the data area. On the far right-hand side of the screen, you're going to see a tool that says Data Analysis. You'll click on that and you'll go to Sampling. Now we see here that it's going to allow us to select what data do we want to sample. So in this example, I am picking check numbers. I want to sample 25 random checks from my check register. And then you'll see that I have two options there. The first option is random, and the first option is periodic, and the second option is random. In this example, we're going to pick random because we want an equal probability of any check being selected. You can input the number of samples that you want pulled back. And then after you do that, you simply click OK. And then your data is returned to you in a separate spreadsheet so that it presents all of that data. Here's an example right here. All of your checks that were randomly pulled with the check number and then also the check amount. Now, there is a different feature that's available in the Data Analysis Toolpak, and that is the periodic sampling. Now, in the periodic sampling, as if you ever work in auditing, you know that periodic sampling is just an alternative to doing the random sampling. In periodic sampling, what we're doing is we're having Excel select every nth value from the input range. So in this example that I'm going to show you here, Excel starts from the very first check number, and then it goes through and it's going to pick every 30th check. So it's going to pull back every 30th check. It's just a different way of pulling information from the data. Again, that area is going to be in sampling. And once you pull that up, instead of selecting random, you're going to select periodic. And then you're going to say that I want it to be every 5th one or every 10th one or every 30th one. So these are two features that are very easy to use in the Data Analysis Toolpak, can allow you to just get a random or periodic look at your data set. Allows you to do a test of integrity, allows you to just do a random sampling of any data that you have. Now, the last tool that we want to talk about before we go to our bonus tool is regression. Now, regression is available in the Data Analysis Toolpak, and regression can be utilized to determine if there is a relationship between two different variables. So, in the data set that you're going to receive, you're going to receive data about purchases in various states and also purchases that are made online. So this is a store, and they're looking at what is the amount of the transaction balance in comparison to the state. And the question that they have, the first question that we have is, do individuals in Arkansas spend more money than in other states? So that's the question that we're trying to answer. The second question that we're trying to answer is, do individuals spend more online than they do in store purchases? So is there a relationship between the online purchases and the amount or dollar amount of the purchase? So regression allows us to predict what we think is going to happen in the future. Predictive analytics is a piece or a part of the data analysis process. In the previous things that we looked at, which was descriptive statistics and histogram, we're taking our previous data and we're looking at what that previous data was. So it's very descriptive. Now we're taking our previous data and we're trying to determine if there was a relationship between that previous data, so then we can make a prediction about what's going to happen in the future. Now, with regression, we're going to look to see if there is a correlation. And a correlation is just a statistical method that determines the degree of relationship between two variables. In the first question that we have the relationship. Is there a relationship between Arkansas and the transaction dollar amount? And we're trying to predict if one variable will predict the other variable. Now, I might mention that it's important when we talk about regression that we always talk about this idea that correlation, having a strong relationship between things, doesn't imply causation. And the way that I always think about this is I don't know if you've ever heard of some research studies, and you often hear of it in the medical area, where it may say something like there's a strong correlation between adults who drink milk and adults who get cancer. Well, that doesn't mean that drinking milk causes cancer. It just simply means that of the individuals who have cancer, a lot of them are milk drinkers. It just means that there's a relationship between cancer and those who drink milk. It just means that cancer drinkers are high percentage milk drinkers. It doesn't mean that drinking milk causes cancer. And so we have to be careful that when we look at regression and we look to see if there's a strong relationship, what does that mean? So, example, in the question that we're asking here, do individuals in Arkansas do they purchase more than in other states? And can I use that as a prediction? We then have to investigate, well, why do people in Arkansas purchase more? Maybe it's because we have more stores in Arkansas, or maybe it's because we sell higher dollar valued goods in Arkansas. So we always have to look further into the investigation. So, how do we get a regression analysis? So, in a regression analysis, you're going to take a data set that you have, and you're going to need to determine what your two variables are. In the example that we're looking at, our variables are going to be the state and then also the transaction amount. And so, regression is actually very easy to do in Excel when you use the Data Analysis Toolpak, because in the Data Analysis Toolpak, there's going to be a regression area, and you're going to be able to click on that regression area. You're going to be able to input your two variables. So in this case, our variables again are going to be the state and then also the transaction amount. And then Excel does the analysis for you. So after you do that, you're going to get this output that looks like this. And so when we're looking at regression, one of the things that we are looking at to determine if there is a relationship is we're looking at the T-stat. And the T-stat value is going to tell us if there is a strong relationship or statistically a greater relationship that individuals in Arkansas spend more than in other states. And so, this regression analysis that we get from Excel, utilizing the Data Analysis Toolpak, can help us understand if there is a relationship, which then can allow us to go in and dive in further into understanding why does that relationship exist. So today we have shown you a couple of different features that are useful for accountants in the Data Analysis Toolpak, a toolpak that often I think people don't even know exist, but it's a useful feature in helping us understand what our data looks like, areas where we may need to investigate further, and understanding exactly what the trends are in our data. Now, we have about 10 minutes left before we're finished with our presentation today. And I want to thank Wendy so much for answering the questions that we have in the chat box. But I want to leave you with one last little bonus feature, and that is taking what we have learned today and applying it to Benford's law analysis. So we talked today a lot about frequency and distribution of data. And so I showed you earlier how you could develop a histogram which shows you the frequency of data. Now, we can use a histogram and apply it to Benford's law. And Benford's law is an observation about the frequency of leading digits. That's the first digit of a transaction amount. So if you think about a check that I wrote, let's say I wrote the check for $5,480, my leading digit would be 5. So we're going to look by using Benford's law, we're going to look at what's the frequency of the very first digit of a number. Benford's law tells me, as an investigator of data, that there's a naturally occurring way that data should align when we look at a data set. And so what I do when I'm doing a Benford's analysis is I look at the frequency and I compare it to Benford's law to determine if my data set is different than what the natural data should look like. Again, simply, it's another tool that we can use to investigate data further. So we're going to go back to that check register data that we have. We've got the check numbers, we got the check dollar amounts, and we're going to try to figure out if our data aligns with Benford's law, with what the natural data should look like. So to do that, I create a histogram or simply a frequency chart, but I have to do it only on the very first digit of my transaction amount. So I create a new column that tells me what that very first digit is, and I use the left formula in order to get that very first digit because it's the most farthest left number in that transaction amount. And once I do that, then I simply am going to go through and create my frequency distribution. Now, what you see here is on the left-hand side, you see the digits 1 through 9, right? Our transactions are always going to start with 1 through 9. And then on the right-hand side, you see that expected column. That expected column tells me what should my data look like if it is natural data, if it's data as expected. So I should see that most of my data should start with the number 1, and then it should go down as we get to our larger numbers. So I took my digits and then I did a count of the number of transactions that started with 1, started with 2, started with 3, etc. And I came up with the actual count of all of my check transactions. Then I simply figured out the percentage of that actual count to total count, and I came up with this overall analysis where I have 224 checks that started with a number 1, where I have 27 checks that started with a number 9. I compare my percentage to the expected percentage, and that's going to identify areas where I potentially have possibly some issues that I want to investigate further. So, how do I easily compare that? Well, I create a combo chart. And I simply create a combo chart, which is a histogram that lines out our actual to expected percentage. So that combo chart looks like this. We have a histogram in the blue bars that show the frequency of the check transactions. And then we have the Pareto line that's coming over the top of it that is showing my percentages. So if you'll remember, the digit 1, the expected percentage was around 30%. My data showed that only a little more than 25% of my data checks started with the number 1. Okay, that seems fairly reasonable, but I can see that in some areas I have significant differences than what the data should actually look like. Transactions that start with a number 4, I have significantly more transactions that start with a number 4 than what is expected. Transactions that start with 6, I have less of those than what's expected. Binford's law simply gives us a way to visualize our data to be able to identify areas that we're going to investigate further. And we can do that by combining a frequency distribution with a histogram area. And so this is a great example of how we can utilize two things together in the data analysis toolpak. Now, again, if you're a Mac user, you always have special, some not always, but most of the time, special ways that you have to go about doing this combo chart or other features. When you get that Excel spreadsheet and our PDF document that walks you through all of these features, you're going to see those special examples given to you, special tips given to you. So, our goal today was to let you know about the Data Analysis Toolpak, and often a toolpak that I believe is really very powerful, but that a lot of people really just don't know or use because it's not automatically built into Excel. So hopefully today you saw how the data analysis toolpak allows you to have the ability to do the analytical piece of analyzing your data and also the very powerful statistical piece that's available from the data analysis toolpak. So we thank you so much for joining us today. I know that Wendy is putting in the chat box the links to the PDFs of our slides, and I'll pass it back over and to you. Thank you.
Yeah, I just wanted to say if you had trouble with your firewall getting through to the Adobe, I did put in the updated link where you could download it from Dropbox directly, and that seems to be working for people. So that's all I wanted to say. So there you go.
Excellent. Thanks, Wendy. Thanks for handling all those questions. I saw a bunch coming in.
Okay.
And I just wanted to thank you, Wendy and Tracy, for an enlightening webinar. Looks like there was some great participation, and I think it went well. So thank you very much. I just wanted to let everyone know that there is a couple of upcoming webinars. I'm going to paste the links for registration. One of them is new, and so there's a couple links there I just put into the chat. So take a look at those. Next week we have an academic presentation from Tamina Ahmed, who is a PhD candidate at Schulich School of Business, and me. So it's a more academic-oriented presentation, but I think since it is on bots and the capital markets, I think it should be interesting to a broader audience. And then the week after that, we have a newly announced webinar by Dr. Colleen Boland on the audit expectation gap in technology. So this is more, again, like today's webinar, a more practitioner-oriented webinar. So that one is new, so take a look at the link I'll post. And also in 15 minutes, you'll get an email from us showing that you attended the webinar, which you can use for your education credits. And next week, we will be posting a recording of this, so that hopefully will work. And otherwise, thanks again for joining us. Hope you have a good rest of the day and enjoy your Friday. Thank you.
Thank you. Thanks a lot.